Bitcoin just crashed to nearly $60,000, and the most dangerous part is not how fast it fell. It is why it fell. No exchange blew up. No billion-dollar fraud got exposed. No government ban hit the wires. No catastrophic black swan tore through the market. Bitcoin simply broke anyway. And that is exactly why this moment is so much more unsettling than the crashes people remember. Because when an asset loses more than half its value in roughly 3 months without a single dramatic event to blame, you are forced to confront something far more uncomfortable. Maybe the price was not being held up by strength. Maybe it was being held up by belief. And maybe that belief is now cracking in real time. Bitcoin touched the low $60,000 range this week after peaking near $126,000 in October 2025. More than 52% of its value vanished. Not over years, not over some slow grinding cycle, in a matter of months. At one point, the selling got so violent that technical readings dropped into levels traders describe as historically extreme. This was not normal weakness. This was full-scale liquidation. And it was not just Bitcoin. Ethereum was slammed. Solana got crushed. The entire crypto complex was hit at once. But here is the part that should make every serious investor stop and think. This was not just retail panic. This was larger money stepping back. This was capital leaving. This was the market questioning the story itself. That is what this video is really about. Not just a crash. Not just another ugly chart. This is about the collapse of the promises that carried Bitcoin to the top. Because if the promises weaken, the price does not need a scandal to fall apart. It falls apart on its own. And there are 4 reasons that is happening. The first is the death of the digital gold story. For years, Bitcoin's most powerful pitch was simple. Gold for the internet age, a scarce asset, a hedge against inflation, a store of value outside government control. Digital gold was elegant, persuasive, and emotionally powerful. It made Bitcoin feel serious. It made it feel timeless. It gave people a reason to compare it not to tech stocks, not to speculative assets, but to one of the oldest forms of wealth preservation in human history. That comparison is now turning against Bitcoin in the harshest possible way. Because when the world actually got uncertainty, gold behaved like gold. Bitcoin did not. Over the last year, gold surged while Bitcoin badly lagged. Not by a little, by a humiliating margin. And that gap matters because narratives are tested in moments of pressure, not in moments of euphoria. Anyone can look like a store of value in a liquidity-fueled bull market. The real test comes when fear rises, geopolitical risk intensifies, and capital starts looking for safety. Gold passed that test. Bitcoin failed it. When major macro stress hit markets, Bitcoin did not act like protection. It acted like a fragile risk asset. It dropped harder than equities during moments of real uncertainty. Think about what that means. The thing that was marketed as an escape from the weakness of traditional finance was weaker than traditional finance when investors actually got nervous. That is not a minor branding issue. That is a direct strike at Bitcoin's identity. Because if it does not protect wealth during inflation scares, if it does not hold up during geopolitical stress, if it does not outperform when confidence in the system weakens, then the phrase digital gold stops being a thesis and starts sounding like an old slogan. And once an old slogan stops working, price can re-rate brutally. This is where many investors make the mistake of focusing only on volatility. They say Bitcoin has always been volatile. It always comes back. It always shakes people out. Maybe. But that misses the deeper problem. The issue is not that Bitcoin fell. The issue is what its behavior revealed while it was falling. It revealed that the market still treats Bitcoin as a speculative risk trade before it treats it as a safe haven. That is devastating. Because the digital gold story was never just one narrative among many. It was the narrative that justified holding through chaos. It was the narrative that told people not to panic. It was the narrative that turned extreme volatility into noble conviction. Now that same narrative is being questioned by the market itself. And once investors start asking whether Bitcoin is really digital gold, they do not stop there. They move to the next question. If it is not digital gold, then who is still left to buy? That brings us to reason number 2. The institutional dream is cracking. One of the biggest sources of confidence in Bitcoin over the last cycle was the idea that Wall Street had finally embraced it. Spot ETFs launched, big money entered, corporate treasuries piled in. Public companies built entire identities around accumulating Bitcoin. The message was clear. This time is different because the institutions are here. That story sounded unstoppable on the way up. But markets do not care how glorious a narrative sounds at the top. They care who is still there when the chart rolls over. And what we are seeing now is not reassuring. It is the exact opposite. ETF outflows have been heavy. Large investors have been reducing exposure. Liquidity has been thinning. Some of the companies that made headlines by aggressively buying Bitcoin have gone quiet or slowed down. The permanent institutional bid that many people assumed would anchor the market suddenly looks far less permanent than advertised. This matters more than people realize. Because institutional adoption was supposed to change Bitcoin's character, it was supposed to make the market deeper, more stable, more mature. It was supposed to reduce the wild boom-bust cycle. It was supposed to signal that Bitcoin had graduated from fringe asset to accepted financial instrument. Instead, when stress arrived, those same institutional channels became exit routes, and in thinner liquidity, exits become more violent. That is one of the ugliest mechanics in this whole decline. When large money leaves an already fragile market, price damage gets amplified. Selling hits harder. Bounces get weaker. Confidence erodes faster. Every drop creates more fear, and that fear produces more selling, which then creates another drop. It becomes a negative loop. That is how markets go from correction to crisis. And notice how dangerous this is psychologically. Retail investors were told institutional adoption meant safety. They were told big money validates the asset. They were told the adults are in the room now. But when the adults start walking toward the door, the emotional damage is worse than a normal sell-off, because the very source of reassurance becomes a source of fear. This is why the current environment feels so unsettling. It is not just price going down, it is faith being withdrawn by the same class of investors who were once used as proof that Bitcoin had made it. Some believers will say this is temporary. Maybe it is. Maybe institutions return later with even more force. But right now the hard truth is simple. Capital is flowing out, not in, and no amount of inspirational posting can overpower that fact. Then the third promise collapses into view. Bitcoin as money never truly happened. This one may be the most awkward truth of all because it goes back to the original dream. Peer-to-peer electronic cash, a decentralized currency for real transactions, a parallel system, a new monetary network. That language helped build the entire mythology. It made Bitcoin sound like a revolution, not just an asset. But look at what actually happened. People did not end up using Bitcoin for daily payments at scale. Not because the dream sounded bad, because in practice, it never fit ordinary life the way believers imagined. It was too volatile, too awkward, too inconsistent for widespread everyday use. And now even major crypto insiders are openly admitting what the market has known for a while. Stablecoins took the payment story. That is the brutal irony. The use case that once made Bitcoin feel transformative is now being dominated by dollar-linked crypto products that do not even try to replace stable value. They embrace it. Businesses want predictability. Consumers want predictability. Payment systems want predictability. A token that swings wildly is exciting for traders, but terrible for routine spending. And that leaves Bitcoin in a deeply uncomfortable position. Because if it is not functioning as daily money, and if the store of value case is under pressure, then what exactly is the core use case ordinary investors are supposed to rally around? This is not a rhetorical jab. It is the central existential question. An asset can survive if one narrative breaks. It can even survive if two weaken. But when multiple foundational stories start failing at the same time, markets get ruthless. Investors begin demanding clarity. They begin asking what the asset actually does, not what it used to promise. They begin separating mythology from utility. And that is where Bitcoin suddenly looks less untouchable than it did at the top. Because the currency story is no longer being delayed, it is being quietly abandoned. Yes, some businesses accept it. Yes, there are still pockets of enthusiasm. But the broader dream that Bitcoin would become common transactional money has faded badly. Even within crypto, that energy has shifted elsewhere. The payments revolution did not vanish, it just moved past Bitcoin. That is a problem, because assets need compelling reasons for capital to keep chasing them. If Bitcoin is not the best payment narrative and not clearly behaving like the best store of value narrative, the market starts searching for alternatives. And while investors are already wrestling with those problems, a fourth threat enters the conversation: quantum computing. This is where many people tune out because it sounds distant, technical, and abstract. That is a mistake. Markets do not wait for a threat to fully arrive before pricing it. They start reacting when a threat becomes imaginable enough to change behavior. Bitcoin's security depends on cryptographic assumptions that hold under today's computing world. The reason many investors felt comfortable for years is simple. Breaking that security with conventional systems looked completely unrealistic. Too much time, too much computational power, too much complexity. Quantum changes the shape of that discussion. If sufficiently powerful quantum systems eventually challenge the cryptographic backbone underlying digital security, Bitcoin does not just face a small inconvenience. It faces questions about the trust model that its entire value proposition rests on. And now that more sophisticated investors are taking that possibility seriously, the issue is no longer fringe speculation. It is entering capital allocation, research, and risk analysis. That alone matters. Because markets hate uncertainty around foundational security, especially for an asset whose value depends so heavily on confidence. No, this does not mean Bitcoin gets instantly broken tomorrow. No, it does not mean doom is guaranteed. But once investors start hearing that firms are spending resources on quantum mitigation, the psychology shifts. The threat stops sounding like science fiction and starts sounding like a future risk that needs planning. And when you combine that with already broken narratives elsewhere, it lands differently. On its own, a long-term technical threat might be manageable. Layered on top of digital gold failure, institutional outflows, and the death of the currency dream, it becomes another crack in the foundation. That is why this moment feels bigger than a routine crash. It is not one wound, it is several. Now step back and look at the macro environment around all of this. Bitcoin's defenders spent years portraying it as independent from the old system, but price action keeps dragging it back into the same ugly truth. When liquidity tightens and risk appetite disappears, Bitcoin gets sold, sometimes harder than everything else. Macro pressure is not some side issue. It is one of the clearest signals the market keeps giving you. Cheap money helped build the great Bitcoin advances. Rising uncertainty and tighter conditions helped punish them. That tells you something extremely important. However revolutionary the branding may sound, Bitcoin still trades like something dependent on the broader financial mood. And that dependence matters because it means Bitcoin does not stand outside the system nearly as cleanly as many people believed. When fear hits, it behaves like an asset inside the risk complex. That weakens its magic. Then there is the liquidity problem, and this is where declines turn vicious fast. As outflows increase, market depth shrinks. When market depth shrinks, every wave of selling does more damage. That is why moves can suddenly look irrational. It is not always because fundamentals changed overnight. It is because the market's ability to absorb selling got weaker. That is exactly how brutal drawdowns accelerate. And yet, despite all of this, not every believer is gone. Some investors are still buying. Some still insist the long-term thesis survives. Some argue Bitcoin has endured worse and recovered every time. They point to prior crashes, prior obituaries, prior moments when the asset looked broken and then exploded to new highs. That history is real. It should not be mocked or ignored. But history alone is not a shield, because the real question is not whether Bitcoin has crashed before. The real question is whether the market can rebuild belief faster than capital exits. That is the battle now. Here is the honest reading of the situation. Bitcoin is not dead in the literal sense. The network still functions. Scarcity still exists. Decentralization still exists. Holders still believe. But the market is no longer paying for those features with the same unquestioned enthusiasm, because the stories that once magnified them have weakened. And when stories weaken, valuations compress. That leaves Bitcoin facing three possible paths. The first is recovery. A new narrative emerges. Confidence returns. Buyers come back. The asset rebuilds its case and eventually climbs to fresh highs. That is possible. Bitcoin has shocked critics before. The second is stagnation. It survives, but with less excitement, less cultural force, less dominance. It becomes a background asset rather than the center of the crypto universe. The third is structural decline. Not a dramatic overnight death, something slower and more dangerous. A long erosion of relevance as better narratives and better tools pull attention away. Which one wins? Nobody knows yet. But what we do know is this. Bitcoin did not get the proof it needed when the pressure arrived. It did not prove itself as digital gold. It did not prove itself as money. It did not prove institutional demand was immovable. It did not prove its security concerns were irrelevant. Instead, at the exact moment proof was needed most, the market saw weakness across every major pillar. That is why the question now sounds louder than ever. Is Bitcoin still the future? Or was it a story that peaked before it matured? That is the real issue. Not whether it can bounce 8% or 10% on a relief rally. Not whether social media can squeeze out one more wave of optimism. The real issue is whether a broken narrative machine can be rebuilt before confidence drains even further. Because price can always bounce, belief is harder to restore. And until belief is restored with something stronger than slogans, Bitcoin will keep carrying this shadow over every rally, every dip buy, every bullish thread, and every attempt to call the bottom. Was this the buying opportunity of the decade? Or was this the moment the market finally admitted the old promises were not enough? That answer is still being written. But one thing is already clear. Bitcoin is no longer being judged by what it once promised. It is being judged by what it actually did when the world tested it. And that is why this crash feels different.